You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
It's management first, management second, management third, and then it goes from there. Good management can take a mediocre asset and make it work. Bad management can generally make a bad asset work, and bad management can screw up a good asset. So that was always the first thing.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and I have a treat for you today. A new guest, someone with many decades of experience in the mining sector that hasn't had a full in-depth interview done before. And I brought him to you today because as I've grown as a resource investor, there's certain things that you need to learn. You need to learn what's the difference between a mineral exploration company, a developer, a producer, a royalty company. You start with those basic building blocks and then you go from there. And one of the ways I've grown is by talking to people with a variety of experience in the mining sector, since I myself don't come from the mining sector, came from outside Canada and outside the mining sector. And one of the ways that I've grown is by just having conversations with people with a lot of experience in the sector. And Brian Christie, welcome on to the show today. You have had a lot of experience in the sector. You've been a geologist, you've been a journalist, you've been a mining equity analyst, you've run IR for a major gold producer, and you're the director of Wallbridge Mining, as well as Fury, of which you're the chairman, Fury Gold Mines, which is a show sponsor. So welcome on to the show for the first time.
Thanks, Bill. Good to be here.
All right, could you give us a little background? How did you find your way into the mining sector?
It's kind of interesting. When I was graduating from high school, I actually thought I wanted to be a pharmacist. So I applied to pharmacy school, and in those days, it was a very, very tough faculty to get into. The Toronto, I lived in Toronto, and there was they took a select number of people, and I didn't make the cut. And I ended up in a BSc program at the U of T, started taking geology, and as I got into it, I kind of found it a lot more interesting. And ultimately, I did my BSc at U of T. When I graduated, I felt I didn't really have enough background in economic geology, so I applied for a master's, did my master's at Queen's, and then got into industry and spent about 13 years as an exploration geologist.
So you got in as a geologist, and were you part of a discovery during that period of time?
I've worked for government. I've worked for large companies. I spent 5 years at Homestake Canada, for example, which was owned by Homestake USA. The discoveries, I've been on two in my career. One was with Falconbridge Copper. I was working as I think I was crew chief that year. We were up at a project north of, or just outside of Thunder Bay. It was called Winston Lake. We had actually gone in, it's kind of an interesting story. We'd gone in to kill the project because it had been on Falconbridge's list of properties for years. And I don't take credit for the discovery. The guy I worked for, Frank Ballant, was the guy that put it all together. He recognized there was a potential for a volcanogenic massive sulfide system there. And so we went in, we started mapping, and we found a large alteration system. We were going to drill 4 holes just to follow up a short program that had been done a couple of years earlier. First hole was kind of funny. The driller said, "Oh, I can't set up here. The cliff's in the way." So we said, "Okay, we'll back up." And so he's drilling the hole, and the night before we went out to check the core, there was like probably a 50-year storm event, washed the road out in about 6-7 places. Took us about 3 hours to get up to the site. And when we got there, we flipped open the core boxes, and I think there was about 5 meters of massive sulfides. So pretty exciting discovery. That ultimately became a mine. Unfortunately, Falconbridge mined it at a down part of the zinc cycle, didn't make any money. But nevertheless, it was pretty exciting. We learned a lot about volcanogenic massive sulfides, which certainly was beneficial at Agnico. The other discovery was a lot more grassroots. I was working for a consultant with a junior mining company, and myself and another guy were out, just happened to be mapping, and he was stream sampling, and we're sitting, I'm on an outcrop, he's collecting a stream, and he goes, "Wow," he says, this is pretty interesting. This sample's full of pyrite. And I went, "What? That's kind of weird." So I was sampling an outcrop, bagged that. We took his sample, and it turned out that we were sitting right on top of what became the Pine Cove deposit in Newfoundland. So I did the original grassroots work, flagged it as this is an area that has to, got to come back here, do a lot more work. And as I said, we were sitting right on top of, it was about a 300,000 ounce deposit gold, and it got mined out by a junior company in Newfoundland.
Brian, you kind of referenced how brutal the mining cycle can be. In the first discovery, you referenced that you can actually have success geologically, but that may not translate into value on a per share basis for investors. Maybe can you share a little bit more about the cycles of mining and what investors need to look for?
The trouble with a lot of investors is they tend to buy higher up in the cycle as opposed to, watch where the commodity prices are and watch where the companies are as far as share price. And I always tell people that, look, after you've been doing some due diligence and watching these things, just make sure if you're investing in a company, there's no fatal flaws that you see. So if everything's good with the company and it happens to be a downtime in the price of metals, then that's okay, because then the timing often relates to when the metal price moves. And I think right now we're in an interesting time for gold that, it's been kind of stuck here. The gold price is 1900 to 1975, which is a great price. But to get it, I think, really moving, we're going to probably have to move well over 2000, probably 2100. But that may not happen until the Fed stops raising interest rates, which, depending on what week it is, they're going to raise them, they're not going to raise them. So I think now is a good time to be looking at the sector. A lot of the juniors are kind of undervalued, and I think we'll see another uptick in the gold cycle. And gold's a little more difficult because it's got different controls on what moves the price. But copper, for example, or even uranium, they tend to be more cyclical. And, the idea here is if you build a big mine, you want to catch a couple of metal price cycles. So, and I think another thing people fail to do is, when stocks kind of really reach a peak and you're at a high point in the metal price cycle, people fail to take money off the table, which is always, and, a funny story, Agnico, a couple of years ago, we kept hitting historic all-time highs. And my wife said to me, she goes, "Who's buying the stock at these historic all-time highs?" So,
and what was your answer as head of IR?
Well, I actually it was funny. I had a few retail investors call me, and they're usually guys out of the US, older guys, retired, have held the stock for years. And one guy was really funny. And I said to him, look, this is a cyclical business. Stock's moving up, take some money off the table. And when it pulls back, you buy back in. And it was funny because he did exactly what I suggested. And he'd call me up and go, "That was great advice." He says, "It's perfect. Now I'm looking at, how I manage my investments like that." So
when you were head of IR for Agnico Eagle, obviously you're dealing with investor expectations as you're talking to investors all the time. And do you feel like a lot of the gold producers, when we're at a cyclical top, it's hard not to cave into investor expectations because that's what they're expecting of you? Would you agree with that, or how would you manage that?
Yeah, well, you bring up a good point because in this kind of last 2 or 3 years, the focus has been on cash flow, and a lot of the investors, some of them want dividends, some of them want you to pay down debt, some of them want you to do share buybacks. So it's kind of interesting because as a gold company, you're a price taker. You don't control the price, so you have to kind of manage your costs and deal with the price that you've got, and then make your capital decisions based on your cash flow generation. So it's always tough. As I said, dividends, investing in new projects, paying down debt. So you got to kind of do a balance here when you're looking at it.
In the last gold cycle, many gold producer executives made some poor decisions for which they lost their jobs. And when I've asked Rick Rule about this, the famous investor in the resource sector, He says it's going to happen again because human nature repeats itself. What is your opinion? Do you think a lot of executives in this gold upcycle are going to make some of the same mistakes?
We've seen quite a bit of discipline so far, but I get nervous that there's consolidation happening, and there aren't what I'd say a lot of good projects out there. So at some point, I think some guys are going to probably pay too much for an acquisition, make the wrong acquisition, maybe get caught offside politically, because the world is constantly changing here. I think, a lot of the places you want to invest in are shrinking dramatically. And, that's one of the things that attracts me to Fury is that we're in Canada, predominantly Quebec, which is probably one of the best jurisdictions, you could be in. So I think there's going to be some chance, but to me, this all comes down to pick your management team. If they've got a great track record, like Agnico, Sean Boyd, tremendous track record, transparent, focused on investors and investor outreach. Sean totally understood, reaching out to institutional investors, retail investors. So the company had a lot of credibility in the marketplace. And even when something goes wrong, the investors trust you and believe that you're going to get out of a situation. Like say, a mine has a certain issue. Well, you explain, hey, this is going to take 3 or 4 months to fix. And, you've got the credibility that they trust you. So I would say always it's management first, management second, management third, and then it goes from there.
Ryan, I've been investing in small Canadian junior mining stocks since late 2015 as an American. And I can tell you that over that 8 years, it's become more difficult to invest in Canadian junior miners, especially as an accredited investor, and a lot of the hoops and hassles we have to go through. How important is the U.S. investor to the Canadian junior mining markets?
I think it's critical to the entire Canadian market. I can tell you, Agnico, we've always focused on the U.S. market. We probably have about 30 or 40% retail. And so it's always been a big component. When Paul Penna ran the company, you'd go to the annual meeting and you'd have 2 or 3 rows of shareholders, largely from the U.S. So I think when you look at generalist money, it's mostly in the United States. That's where the big pools of capital are. We're not seeing, I just don't get a good feeling. The Canadian institutional market is shrinking. I think there's a demographic change in some of the retail investors. But that said, I was glad to read a Kitco article that said millennials apparently have 10% gold in their portfolios. That didn't necessarily mean stocks, but at least they know what gold actually is compared to probably Bitcoin. So I think it's very important to reach out to U.S. investors. And I understand where you're coming from. Like I know myself, even if I want to do, say, a private placement or something, I have to fill out all kinds of paperwork, and then it gets even worse. As an insider, if I'm buying stock, I got to make sure all the filings are done. And yeah, totally understand where you're coming from. And a lot of it, I guess, they're just trying to prevent, issues.
So, Brian, after you worked as a geologist early in your career, you then had a stint as a journalist in the mining sector. So what were some of your key takeaways for investors? What did you learn there as a journalist?
It was interesting, Bill, because at that point in time when I joined the Northern Miner, I'll give them a plug here, because if you're a resource investor, that's a great paper to be subscribed to. The news, when you get it, the news is probably a bit old, but it gives you great insight looking at site visits and just the stories. And when I joined, the diamond market, Canada and international, just started to take off. We made the big discoveries in Northwest Territories. And then Canadians were starting to go globally, where they were looking at projects. So I was traveling all over the world looking at, you name it. I was probably there looking at uranium or copper, gold, diamonds. And I think the big issue here is, again, trust the management, do some due diligence on the projects, and everything in jurisdictions is great until it's not. So I think pay a lot of attention to where the companies are. There's hot spots in the world right now. A lot of West Africa is starting to kind of wobble. Obviously Russia, Kinross had to exit Russia back a few years ago when the Ukraine situation came around. So I think a lot of it is know your management teams and pick decent geography.
After you were a journalist, then you worked as a mining equity analyst for, I think, almost 2 decades, right?
Yeah, it was about 17 years. And it was funny because that job I got involved in the mining analyst career, and it was a connection I made on a Northern Miners site visit. I joined Canaccord Capital back when they were just really building their Toronto institutional team, and went on to work at several different Canadian equity dealers.
So when you were at your desk and on paper you're analyzing a miner, what were some of the key metrics you would look for?
Again, it would always be management. Good management can take a mediocre asset and make it work. Bad management can generally make a bad asset work, and bad management can screw up a good asset. So that was always the first thing. And then again, good geology with the ability to grow reserves, resources. Also another thing that, well, it wasn't so much back in the days when I was a mining analyst, but it's community engagement. You got to make sure the companies are engaged with the local communities, First Nations groups. All of that is very, very important, because you can have a great project and it gets stalled out because you've done a very bad job dealing with local communities, local government, whatever.
So beyond just a superficial due diligence when it comes to local communities, if the company says everything's fine, but then you get a news clipping or something that there's some dissatisfaction at the First Nations level, as an investor or an equity analyst, what would you do? Would you pick up the phone, or would you do a site visit, try to talk to the locals?
Yeah, as an equity investor, before I would cover any kind of company, I would go to site. So as part of my due diligence, I always made sure I went to site, and that usually meant meeting some of the local communities, meeting government officials, and just totally understanding kind of the landscape. And these days, a lot of this stuff you can screen, on the web sort of thing, right? But as an investor, if I see something that's happening from, say, a political or community level, I would be phoning the company and saying, hey, what's going on here, right? Like, I read your stuff about ESG on your website and it all looks great, but, I'm not getting a warm, fuzzy feeling from, what I'm seeing in stories on the internet. But also you have to be careful with what's on the internet, because it often isn't the exact case of what is happening. So pick up the phone, call the CEO. If it's a decent company, you're going to be able to get the CEO on the phone.
When you were at Agnico Eagle leading investor relations, from your vantage point, what did you feel like investors misperceived or got wrong the most?
Probably the timing in the cycle. As I said, they often tend to buy when prices are ramping, and that's often difficult because you never know when the price is going to roll over. I also think now there's too much short-term focus on, earnings, quarterly earnings. A lot of that is generated by the hedge fund community, because those guys have become some of the dominant institutional investors with a lot of the big brokerages, whether it's in the United States or Canada. There's kind of a list of maybe about 80 of them, and they're the guys that are doing the trading. They're the guys that are shorting, going long, and everything's this short-term focus. And I think as an investor, you need to take a longer-term focus. Like, a company every so often on a quarter is going to miss earnings, but if they miss earnings by a penny, is that a big deal? No, because then the next quarter they're going to beat by 2 or 3 cents. So that kind of thing, you kind of got to, that's kind of noise. As I said, always look to see if there's a fatal flaw somewhere, then that's a different story. But, you can't really focus on the short-term trading, and you probably have some clients that do short-term trade. But again, as I would say, if you buy it in the right time at the right point when it's not, running up to the moon, then I think you've got the ability to trade, take some money, and, just be smart about it.
I've heard it said that institutions offer a stock stability, but retail offers a stock liquidity. Do you think that's an accurate statement?
I'd say some of the retail investors are very loyal. And so, yeah, that's probably true. I think the hedge fund guys probably offer some liquidity too. But yeah, that's probably valid. But at Agnico, we've had some very long-term retail investors.
Brian, you could be doing anything at this point in your career, but you've chosen to be the chairman of Fury. You accepted that role more recently. What's your vision for the company, and why did you accept the role?
I've known Tim for probably over 20 years. We've been fly fishing, trap shooting, golfing. He was a great partner when I was in the capital markets business as an analyst. He got me in front of key investors, worked hard. It's interesting because he had built a good relationship with Agnico before I even got there. And I like Tim because he's got a ton of energy. He's always thinking. He's thinking more like he's running a business, not just a resource business. And he's also focused on making sure there's good culture with the executive team, with the board, and everybody interacts well. So I like the transparency there, how he's thinking, because we'll chat about ideas and, what could look like a great idea, maybe 2 days later it isn't, but you move on to the next thing. And I think you always have to be almost reassessing your business and seeing where you're going and how you want to grow it. And Tim, as I said, has a lot of energy, great relationships out there with a number of companies and a lot of the institutional investors. I think he's learning a lot about retail, but that's good as well.
And what about at the project level with Fury? Obviously, that's central to the company's investment thesis.
Yeah, we were just up at Eau Claire a month ago, roughly. And I was blown away by the infrastructure, like the Quebec Hydro infrastructure. We landed on an airstrip where you can land probably a 737 because it's for this is the James Bay Power Projects. Got in a truck. We could have got in a car. And we drove all the way to the property, got there, and the amount of trenching and historical work that was done by East Main Resources that I don't think really necessarily got all put together that well. So I was just blown away with the access, the amount of data. There's lots of trenches, there's sampling, there's some areas almost football field sized outcrops have been stripped. So when you're drilling a lot of these things, you can look at the surface geology and say, okay, now I know what's happening and where I'm going to chase it. And I think it's a tremendous property. We have a known resource at Eau Claire. We can build on that. But I think the really exciting thing is the number of targets elsewhere on the property that need to be assessed, drilled. And, we've had great luck at Percival. And we've got a bunch of other targets on the project, and it's just a matter of systematically exploring. Great technical team. That was another thing that, I met the guys, David Rivard and Brian Atkinson, solid guys. Margot on IR, and our CFO. He's just stepped in. He was the controller, but I think he's going to be a great CFO. So I think it's a great team. Great location, as I said. You can't beat Quebec, and I kind of like when I can drive my car to a project. I don't have to worry about building a road for 200 kilometers or flying everything in by Hercules or stuff like that. So, and the thing with Eau Claire, you can almost plug and play into the hydro. So it's in this day and age when you want good, reliable power that's green, great place to be. And then, we've also got the joint venture with Newmont, their project Eleanor. And so, again, it's right by a producing mine. Pretty good place to find more mineralization in the shadow of the head frame. So,
excellent. Well, Brian, thank you for coming on the show today, sharing your insights and sharing a little bit about your story. I appreciate it.
Great. Thanks, Bill. Good to be here.